Good morning, everyone. Welcome to the rundown for global stocks for the 13th of March. It's just another amazing week. I know I keep saying that every week, but the central banks just keep rolling out the madness. And on Thursday night, the ECB, courtesy of Mario Draghi, came out with a set of policies that I think really exceeded anyone's expectations. And it's just really hard to fathom. I really don't know how to express my surprise at what central banks continue to do. And I think it's important too to draw a distinction between the way that the various asset markets, be they stocks or bonds or currencies, respond, and what is actually happening in the real economy. Because to my eye, there is a distinct difference between the two. The asset markets going up would suggest here that what the central banks are doing is working, but clearly the real economy is not saying the same thing, that's for sure. So let's get on and have a look at what actually transpired. Just a bit of global perspective, first of all. What the ECB actually did was they reduced the cash rates to zero. They further went into negative territory on the deposit rate for commercial banks. So it will now cost commercial banks 0.4% to lodge their funds with the ECB. They expanded their bond asset purchase program from 60 billion euros a month to 80 billion euros a month. And plus, for the first time, they are now going to buy high quality corporate debt as well, allowing the corporates in Europe to have basically a ready market to sell even more debt. So all that's happening here is the debt bubble is just being blown up further and further. Um, and so the question that is pretty obvious to anyone that wants to stop for 5 seconds and think about it is, why is all this necessary after 7 years of stimulus if what they're doing is working? Clearly it's not. If it hasn't worked in 7 years, it's not going to work, and all they've done this time is just throw the kitchen sink, the garage, and half the living room at the economy. But I just can't see that it's going to make any real difference. Is it going to make consumers want to spend? Certainly, a lot of the material that I'm reading suggests that people are getting quite nervous about what central banks are doing, and so if anything, it's making people go the other way to not invest or to spend, I should say. And is it also going to make businesses borrow and invest as well? Because businesses only do that if they can see the high prospect of growing their business. Well, if they're starting to doubt that they're going to get a return, then why would they borrow even at insanely low interest rates? It just doesn't make a lot of sense to me. So I think there are going to be unintended consequences. You can't run an experiment like this and not have unintended consequences. And the problem is that no one really knows where this is going to pop up next in terms of a problem. And the biggest problem of all, and the one that that I focus on, is that I think all of this is just contributing to a loss of confidence in central banks. And I've said it before, the whole world's financial system relies on confidence. Without confidence, it doesn't function, because a bank takes in $1 and lends out 10. You can only maintain that system when people have confidence in the system. So that's the biggest concern for me, is that this could be the start of a progressive loss of confidence in central banks, and then who knows where that will go. Now, I really hate making these comments because, I start to sound like some of these doom and gloom people, and I've resisted that for most of the last decade. So I really don't enjoy making these comments, but I think we've reached the point now where you've just got to step back and ask yourself a few rational questions about what's going on. So just an observation, as I alluded to at the start, the real economy is being, and this is in Europe and in America and in Japan, the real economy is continually being prevented from adjusting to the reality of where things are, by ongoing central bank interference. These guys just can't stop doing things to try and prevent the normal economic cycle of boom and bust that has to play out. They're trying to prevent it, and I don't think it's something that can be prevented. And the longer it goes on, the worse the eventual outcome is going to be. So I don't really feel at all comfortable about looking down the track 5 or 10 years. The only question is, how long can they keep this going before asset markets really start to show a meaningful response? Is it is it a few months? Is it a few years? I have no idea, because this is all about confidence. But I really don't like the direction of where this is going. However, the global banks, initially the reaction was a bit negative, but then when traders thought about it, they came into Friday and global banks lifted in Europe and also in America. We saw a bit of a lift in our banks on Friday. I think that'll follow through quite nicely on Monday. So a positive response in asset prices doesn't mean that we're getting a positive response in the real economy. And you've got to say, by definition, that we haven't, because after 7 years, why are they ramping the policies up even bigger and larger than anything that they've done in the last 7 years? So clearly, the response in the real economy is just not happening. So now, and I hate to say this also, but all eyes turn to the Fed Tuesday night, Wednesday night, and so markets will be basically hanging on that. We seem to be constantly in this position of the next central bank announcement and then how markets will respond. So it's almost a bit of throw your hands in the air type stuff at the moment. Now, I would also observe that markets are not doing what they're supposed to do based on history and logic. With what the ECB did on Thursday night, you would have expected the euro to plummet. And it did initially for about 5 minutes, and then it went straight up and actually ended up higher. Now, that defies logic. The bond market has done things that defy logic. So in a number of markets, they're just not doing what they're supposed to do based on history and based on logic. What is happening is that this is very much a technical traders market. And whatever technique you're using, if you are not mindful of the fact that markets are moving on technical grounds far more than anything else, then you're going to be in trouble, because that's the reality. Whether you like it or not, that is a reality. This is a technical traders market, no question. Turning now to the American stocks, the S&P rose by 22 points. That was pretty much all on Friday. We saw a break of that key resistance at 2,000. We're now basically at the next resistance level, but it did manage to close above the 200-day moving average. And again, whether you like it or not, think it's black magic or not, the fact is a close above the 200-day moving average for the first time this year will bring in a significant amount of additional buying. That's just the way markets work. If a lot of technical traders will jump on that. So I think in the very short term, we're likely to see markets push on a bit higher. Now, last week, this is what I said. The key, when we were just under that 2,000 point level, I said the key is how prices react around this level. A mild 3% pullback will be rather bullish. We didn't even get a 3% pullback before we broke it. We got maybe 1%. So you can only interpret the short-term action as being really quite bullish. Breadth has improved further. So in other words, the number of stocks that are participating in the rally has increased quite sharply and quite dramatically. But I will observe that the defensive sectors of consumer staples and utilities, there's still a fair bit of money going in there. Yes, there's money flowing into some of the more aggressive sectors, but it's not at the expense of the very defensive ones as well. So there's still an element of caution in the market. But the bottom line is that the price of oil is what's driving stocks. Oil jumped up to 38.5 West Texas Intermediate crude on Friday night. And as long as oil keeps rising, then stocks will keep rising. It's pretty much as simple as that. So let's stop and take a look at the chart. This is the S&P index on the big picture monthly view that I've been showing now for a couple of years. You can see that we've had a very substantial rebound already, even though we're only a week and a half into March. It's been quite a substantial rebound. However, on the big picture level, the moving average has rolled over. The price has been under it for the last 3 months, and certainly still has the potential to unwind further. But the short term, if we look at the shorter term, you can see that the move on Friday night was a substantial one. We had quite a lot of fluctuation on Thursday. As you can see, that's a fairly big range. The market opened and closed at the same level, but it traded over quite a substantial range from 1969 all the way up to 2005. That's a big range. But then turned very positive, and you can see the red 200-day moving average managed to close just a tick above that. And I think in the very short term, even though markets are overbought, look, it might pull back, but this is very bullish short-term price action. The next resistance level really is up around about the 2050 area, and if we can break through there, then, which again would defy logic, but however, that's you just got to go with what is actually happening in the market at the moment. So certainly the US market looking quite strong. If we look at the Russell 2000, this is the ETF that tracks that. The three key levels that I had were at 104, 107, and 110, which were the three Fibonacci retracement levels of this run down from the 2nd of December to the bottom. We went straight through the first one without pausing, and the second one we had a little bit of a pause for a few days, but again quite a strong session on Friday night. A break of 110 on the Russell would really pretty much nail it for me in terms of a move back into a strong uptrend. But I think certainly already what the markets are saying is that we've had a lot of strength. If this market was weak, it wouldn't have got past the 38.2. The fact that it's gone through the 50 pretty readily and is knocking on the door up here tells us that there's a fair amount of strength in that market. So I think the likely scenario now is a broad sideways market with the possibility of a break to new highs. I really have trouble getting my head around that, looking at all the things that are going on. But you've just got to go with the price action as it stands. Turning now to the Aussie dollar, it's been very strong. The Aussie dollar, the Canadian dollar have moved up quite strongly. So the commodity currencies, and we finished at 75.6. So this is all about improving commodity prices, but the question in my mind is, should commodity prices be rising? And the resounding answer that I get is no, with the exception of gold. The move in iron ore, we saw a 19% jump in iron ore in one session. That was really due to a combination of several transient factors that have pretty much all gone away now already. And it looks unsustainable. And even BHP and Fortescue have said, look, $35 to $45 a tonne is probably more like it. Above 60 is really just not supported by supply and demand at all. So I think you will quite possibly see the Australian dollar back off when iron ore backs off. There's also been, of course, a continuing bit of a rally for oil. There's resistance at 40. It's at 38.5 at the moment. And to me, nothing has changed in the supply and demand. We've still got an imbalance there. We've still got the world completely awash in oil inventory. Every little nook and cranny is pretty much filled up with oil. It's going to take a year or two to clear that. And that's even if they can get supply and demand back into balance, which requires production cuts, and I just can't see that happening. I really can't see how you're going to get the Saudis and the Russians and the Iranians and all the other major players. How are you going to get them to agree to actually cut production, because they don't trust each other, and they're not going to give up market share or cash flow for their economy on the hope that everybody else plays ball with them. So I just can't see it happening, frankly. So I think the rise in the oil price has just really been about short covering and speculation, and therefore I would expect iron ore to turn down again and oil to turn down again as well, and that should pull the Aussie dollar back. Turning now to Aussie stocks, our index was up by 76 points for the week, but I would imagine it'll be a pretty solid session on Monday. The downtrend in the ASX 200 is still in place, but the index is just having a little bit of a peep above the top of the channel. We'll look at that in a minute. But we did see some strength in the banks on Friday. But I did also note too that energy, as opposed to energy in America and energy in Europe, energy stocks in Australia have really failed to respond. And I wonder whether that's just the fact that the Australian dollar's been rising as well has kind of kept the lid on them or not. But anyway, we shall see. Let's take a look first of all at the Aussie dollar. So you can see we've clearly made a move. We're now overbought. It's hard to see on fundamentals, see the Australian dollar moving any higher. And I think as soon as you see some heat come out of those commodities, then we'll see the Aussie dollar back down again. If it doesn't, then I think the RBA will probably have to move and reduce interest rates. So turning now to the ASX 200, just pan back and give you a look at so there's the big picture downtrend channel. It's been in progress now since April last year, so it's about a year. We've moved to the very top extremity. We're just having a little peep over the top, but it'll obviously all depend on what happens with the overseas markets and in particular our banks. Turning now to gold, was down $8 for the week, but it was really quite volatile. A retracement to 1200 would be quite healthy for an ongoing big picture uptrend. To my mind, negative interest rates are probably going to be a positive for gold. I know a lot of people relate positive moves in gold to inflation, and there is a relationship there, but there are other relationships that are just as important. And when interest rates are neutral to negative, then people aren't missing out on anything by being in gold. Gold doesn't provide you a yield. So if you can go and get a yield somewhere else, then you might do that rather than punt on a capital gain on gold. But when interest rates are zero to negative, then there is no disincentive to be in gold. And if you then start to combine that with a loss of confidence in central banks, then there is a real strong rationale to move more into gold. But look, having said that, even without gold moving, the elite gold businesses around the world, the best businesses, are in a very strong financial position. They've got very significant profit margins. The good ones have got very low to nil debt. And the other thing is that the ratio between the average price of stocks, if you look at the stock indices, and the price of gold, remains close to a historic low. And that makes no sense to me when there is now a bit of a move starting up in gold itself, and a good reason for that to occur. So I think there's a very, very good chance that we'll see over time quite a good rebound in gold stocks. Copper was steady at 227. WTI crude was higher to 38.50. And as I said before, I think surely that's just more about speculation on what could happen. could the Saudis and the Russians reach a deal, etc., than it is about what is actually happening at the moment. There's the spot copper chart. I will just go back and look at the gold chart. So we'll start first of all with the weekly view. So you can see it's managed to move above that downtrending channel. So quite positive for gold on a big picture view. And if we zero in a little bit further, you can see it's been quite a strong move. We had a little 2-day retracement to test the breakout. If we got a retracement now back to around this 1200 mark and also back to the top of the channel, then technically that would be ideal. That would also be a 38.2% retracement of the move that we've had so far. And I think that would be a good thing, because gold stocks are a bit overheated at the moment, so it's not necessarily a time to be wanting to jump in right now. So overall, to wrap it up, the only way to deal with this market, and I've had this little screen up now for a couple of weeks because there really isn't anything more appropriate to say other than if you just got to work from the extremes of price and sentiment. If you're trying to play the market in the middle when it's not at those extremes of price and sentiment, then it's a lottery. It could go either way and could go either way very quickly. Don't stay in a position for too long, because the market's likely to reverse and drive over the top of you if you do. And don't rely on fundamentals or logic, because frankly they're very much the lesser contributor at the moment. It's very much about fundamentals, about technicals, I should say. Finally, don't chase a trend. The further a trend runs, the more likely it is to reverse, and those reverses are quite sharp these days, thanks to the computer algorithms. So that wraps up this week. I'll be able to comment on what the outcome of the Fed meeting will be next weekend and the market response to it. So look, it just rolls on week after week. We just seem to be held captive to what the central banks are doing. For anyone who's not a member, there's my contact details. Love to communicate with you, and be back with you next week. Cheers.